All right, ready to roll?
Ready to roll.
Awesome. So before we begin, and so I don't screw up on everyone's intros, we'll do 30 seconds of intros. So starting with Ben, let's hear it, what you're up to and what you're excited about.
Sure. I'm Ben Narrison. I am a venture partner at NEA, New Enterprise Associates. It's still currently, if you don't count SoftBank, the largest venture firm in the world. Fintech's been a long-term focus. I've done everything from Lending Club and Cabbage to Zenefits and a bunch of insurance tech companies. And insurance tech's probably an area I still remain pretty excited about.
Awesome.
Mike Walsh. I'm a general partner and co-founder of Greenvisor Capital. We focus exclusively on early stage fintech. We have a very broad approach to fintech. It includes the obvious fintech stuff from payments to lending to insurtech to less obvious stuff like enterprise software companies where there's a large application within financial services, or data companies where there's a large application within financial services. And we do have a global mandate. We've now invested across 4 different continents. We've been around for 5 years, have about 30 portfolio companies, and very active value-added approach. We're on the board or board observers of 22 of our 30 portfolio companies.
Hi, Victoria Chen. I'm at Citi Ventures, Senior Vice President of Venture Investing there. And we really focus on 2 different types of investments. So the first is fintech companies, obviously, lending, banking, payments, capital markets, et cetera. And then also, similarly, enterprise IT companies that service financial services. So companies like DocuSign, Anaconda, Immuta, et cetera.
Well, thanks for having us, Lloyd. I'm Kat Utak. I'm managing partner at Core Innovation Capital. We invest in companies that democratize prosperity. About 80% of our companies are in fintech, B2B, B2C, everything from crypto companies to traditional lending, payments, banking. 80% of our initial checks are also in the seed and Series A, and normally
Awesome.
leading.
So we'll start with you. So what are you seeing right now? What are you most excited about in fintech?
Pretty much anything that walks in my office that isn't crypto and doesn't have a coin, I'm like, it's kind of refreshing. But I'm specifically interested in health insurance, and we've seen some big players there. I think the healthcare market's extremely inefficient. And so it's whether you have new full stack carriers, Oscar, who obviously just raised a large round. We'll see what happens there. Clover. There's a new Medicare Advantage one called Devoted Health from a really strong team, to just people that are enabling the space. We have an investment in a company called Health Sherpa, which shepherds people in the right health insurance plans. Enrolled over 1 million people in the ACA that wouldn't have access to the right affordable health plans. And actually, we just invested in a new health insurer on the blockchain called Decent. So again, people that are really trying to disrupt something that's an extremely inefficient market. I think in the U.S., we spend a good part of our GDP on healthcare, and it's about like 4x than most other countries. So we clearly have to change, and I believe more in private solutions than the government solutions for healthcare.
Fantastic. Victoria, how about yourself?
Yeah, so I think on the enterprise side, we're really interested in how do you build an entire stack around big data, right? So if you really want to leverage machine learning at scale within the enterprise, what are the tools, the capabilities, the infrastructure that's necessary to do that? And so there we have a ton of companies that help us in that segment, right? And then we also look for vertical applications of that. So companies like FeedZai in our portfolio, which applies AI and machine learning to fraud in particular, right? I think on the fintech side, we're looking a lot at insurance. What are the things that you can do today that you couldn't do before because you have sensors in places that you didn't have before, right? Because you have data that you didn't have before. I think that's an area that we think is pretty exciting.
I'll mention 2 different things that would probably take a long time to explain and try to explain them in 10 seconds. So I apologize if I leave some things out. But I think there's a lot of companies talking about doing stuff in AI, but we've backed a company that I think is a true and innovative application of artificial intelligence to capital markets. It's a company called One Kronos, which is using AI to power financial exchanges. And they've basically used the same techniques that Google used within AlphaGo to beat the world Go champion, to bring a combinatorial auction to capital markets. And most mathematicians would tell you that the most effective mechanism for solving an auction with multiple constituents and volume and price is to use a combinatorial auction, but it could never be done at capital market speed until very recently with modern compute and with AI. So they've effectively, we think, is a step function change in the ability to eliminate a lot of the kind of race for speed within capital markets, but also create a lot of innovation around the types of orders you can submit and unlock a lot of liquidity. And then separately, within the crypto space, where we do have a lot of skepticism, one area where there's clearly been kind of product market fit is in capital formation and secondary trading. So we're a believer that over a long period of time, blockchains will eat one asset class at a time. So it's already playing out within equity in ICOs. For all the faults of ICOs, of which there are many, it's proven to be a very effective mechanism for capital formation and secondary trading and price transparency. So we focus in on debt capital markets as the next kind of leg in this food chain, and it's an orders of magnitude bigger market than equity. And I think a lot of elements of smart contracts make even more sense within the debt capital markets. And it's a market that's much less transparent in terms of price transparency, much less liquid than equity markets. So I think if you can bring some of that liquidity and price transparency and the ability to build securitizations much more effectively through smart contracts, I think that's a very intriguing proposition for the debt markets. So we've backed a company called Dharma Labs, which is building an open protocol for tokenized debt issuance. They've not done an ICO, so I'm very skeptical of a lot of companies that are doing ICOs, but they're a traditional startup company that's building infrastructure for tokenizing debt.
Fantastic. How about you, Ben? What's exciting you in the space?
I think that a lot of the white space in fintech in general has been inked in, a lot of lending and on and on and on. I do think insurtech as a subsegment of the fintech category remains pretty exciting. Almost every category, whether it's health or home or P&C, business or personal, has a lot of room for disruption. These are enormous industries. You look at any given country and there's multiple tens of billions of dollars of value insurance players up and down the stack. And I think that startups have an opportunity to disrupt a lot of them. I don't think any of them are going to die. They're just actually too big to die. And I think that will remain true for a long time. I'm not sure that my mother will ever go online and buy her insurance with a swipe. But a lot of people will. And I'm impressed by the level of adoption. Actually, one of the things that's sort of intriguing to me is if you're insuring one of the most important assets you have, your car might be your most important asset at a certain age. Your house might be your most important asset. If you're willing to insure that through a startup online in volume, it's a pretty telling thing. You're buying from a brand you didn't hear of until 2 years ago. So that also speaks a little bit to consumer behavior. Then there's some things that are somewhat orthogonal that I'm intrigued by that may or may not become big enough. There's alternative credit. Look at things like Nova, which is doing sort of credit for international in the United States. You look at fraud issues. There's a company out there that's helping try to attack synthetic fraud where people are spinning up false identities based on real social security numbers and then, basically attacking a lot of lenders all at once and defrauding them of a lot of capital, and it's not even obvious to the lender that that's what's happening. And then there's some SaaS software systems that go inside of larger fintech organizations that could become Trojan horses to fintech businesses. And then lastly, I think has been pointed out by a bunch of people, there's a whole data business around this. We have a company called Enigma.ai, which provides access to about 100,000 public data sets, and most of the fintech industry has found that there's an enormous amount of value they can achieve from that, whether it's underwriting or fraud or risk or even sanctions. And so there's just a lot of things now that fintech has gotten so much bigger that can attach to it and be potentially big enough on their own.
Fantastic. So one thing you touched on was these new companies don't have a big enough brand, but they're going after the larger companies. So what have you seen that's successful? You're seeing a lot of fintech companies. What is their approach to market? What is helping them win? What's working, what's not working? Would love to get your thoughts.
So I think it varies by company. When I was starting out, so I was an entrepreneur for 25 years. I was a seed investor for 10. I've been a VC for about 3. And I remember taking a deal to a VC once, and I said, you're going to love this one. It's better, faster, cheaper. And he's like, yeah, I can't buy that. I'm like, what do you mean? He said, well, I won't buy better, faster, cheaper because next year somebody else will be better, faster, cheaper. I need people that have an unfair competitive advantage. And I thought, well, that seems blatantly unfair. But it's true. You need something that's differentiating in a way that others either aren't able to get to or haven't figured out. Acquisition is a big part of that. I think a lot of this does drive towards effective cost of acquisition, because if you don't crack that nut, the rest doesn't really matter. I still am a bit quizzical as to the level of trust that people will provide. And this goes all the way back to, I funded a company long ago called Page Once, which became Check, which was sort of meant for mobile that Intuit bought. And you put in all your bank account data information and it showed you all your stuff in one app. Again, a startup where millions of people would say, here's all my credentials for logging into a bank. And that was at the time, I mean, I even personally didn't use it. And I knew the founders because, there's 120 employees. How do I know who's a rogue? It is amazing to me the trust we give as a society to digital companies that we don't yet know, but we do. And that's been proven not just by the acquisition and the driving down of acquisition costs. The other thing I'll quickly say is there's lots and lots and lots of different ways. Typically, I find that entrepreneurs will try 100 things and one will work. Whether that's direct mail, which has been effective for a lot of people in fintech and is amazing because think about it. There's so much less mail in your mailbox. That one big postcard you might actually read. Television, there's obviously online. But if you're just dependent, if your business is based on I'm going to buy a customer for $100, I'm going to make $120, well, it's not a venture business to me. You need to find a way to get it to be a much, 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 much bigger spread.
Mike, how about you?
Yeah, he hit on, I think, the most important point in fintech. There's so much noise. There's thousands of new fintech companies. There's tens of thousands of incumbents on the consumer side. And you can't just go out there and acquire on Google and Facebook and think you're going to win. I'll talk a little more about the enterprise side just because we've done more deals there. I think a lot of startups think they're going to build something that's, as you said, better, faster, cheaper and sell it to Citi or B of A. And you end up becoming kind of their innovation arm and you just become a consultant. And you do a POC and you get paid maybe $100,000 or $500,000 and you think you're off to the races. And then you end up building a product that they never want to use and will never pay for on a go-forward basis. Or you build a product they want to use but nobody else wants to use because it's so customized for that use case. So the enterprise fintech companies we've backed that have been successful have started out much further down market, building technology and infrastructure for fintech companies and automating a lot of the processes for a lot of the new alternative lenders or a lot of the new insurtech companies. We have a company that just sold to Q2 where they're building origination, underwriting, and servicing software. Or you have companies like Plaid that are being the intermediary between fintechs and banks. So I think starting with fintech companies as your customer early on and then building the scale to start selling into banks has been a much more successful strategy than going straight to the top, where you might have a 3-year sales cycle and you might run out of capital before you hit the milestones you need to raise the next round of financing, or you might build a product that doesn't make sense for anybody but that bank.
Fantastic, Victoria.
Yeah, I think you have different approaches, right? So if you're going direct to consumer, direct to a client, whether it's an SMB, a commercial client, or a consumer client, most of the companies I would say that have been successful have found that it is a space that is underserved. Right? It is underserved because it is down market. It is underserved because it is really expensive and inefficient for large enterprises to actually service, or it's underserved because you can't reach them, right? There's a distribution issue, or it's underserved for any number of other reasons, right? There's a lack of credit data and you can't actually underwrite them, right? Or it could be any of those things. And I find that that's where there's less competition from large enterprises like ourselves, right? If you're trying to build a consumer lending credit card company for prime customers, that's gonna be really difficult, right? Because that's where we spend all our money and we have a lot of money to spend. So that's the kind of stuff that we're interested in, right? So this democratization where, we have investments in companies like Betterment, right? Where it's not super practical for us to bring on clients that have $5,000 for a brokerage account and do investment advisory, right? Companies like Bluevine, which are serving SMBs, where, for a lot of large banks, it costs as much to serve an SMB that's taking out $1 million loan as a commercial client that's taking out a $20 million loan. And so because they have these advantages, they're able to do things, acquire those customers, be much more efficient at servicing them, and that allows them to grow in a far easier part of the ecosystem, right? So I think that's a large part of it.
I love my peers. They covered a lot of what I'd say. But the other thing I'd say, especially of late, it wasn't like this years ago. I mean, this is the fintech sector. It's highly regulated. And I think what people sometimes get wrong is you cannot hack regulation. You can hack all sorts of other things and growth here, but you can't. And we always joke, it's normally not two 20-year-old guys in a garage trying to build something. It isn't the hotel lobby or the taxi lobby. You can't break some rules and then like hope that the CFPB won't shut you down. Like they will. And so you have to take regulation, seriously from the start, build that in, like make sure you have a great chief compliance officer. And I think where companies have gotten into real trouble, and we've seen it at all stages from early to late, is just not building in like a culture of compliance and governance and regulation.
I like that though. I think it's a theme for another talk, growth hacking regulation. So let's talk about some of the big players, Google, Amazon, Facebook. Everyone seems to be getting into this space. What is your take on this? Where do you see them going? How do startups play with them? That sort of thing. Yeah.
So you get to lead, so you can steal all our stuff.
I'm the contrarian here. I know people are more bullish about them doing great things in fintech. Again, fintech's a really hard area to understand, and you've seen people, right? Facebook has tried a lot, and then they'll shut things down. I think they tried to sell goods before, tried to do like Venmo type things before. Will that work? When people, especially Americans, and we're focused mostly on the US, when Americans are looking and going to specific sites, I guess Snap is getting killed now, but when they're going those places, they're not going there to like transact or to do banking services. I don't know if they will. Like Amazon or like Square doing SMB lending, that makes sense, right? You have SMBs there. So there's parts of financial services where like, okay, that person there will actually be thinking about that, that particular use case. I think them just becoming a bank, I'm a lot more skeptical. I don't even know if they really, want to take on that challenge. It'll be interesting. Is Amazon going to offer us insurance? Are they just like testing out on their employees? Possibly. Again, I don't think they're going to be a winner. So that differs from a lot of people. And then I know, we had talked about before is like, well, okay, but if you look at China, things, WeChat, everyone's transacting there. It's a whole different culture. First of all, like in the US and in a lot like of Europe, like you've had credit card systems, you've had other financial systems that had never hit China. So by the time you could start buying goods, there wasn't like all these ingrained incumbent solutions, nor were these ingrained behaviors. And so we have these certain ingrained behaviors. So I don't think people are going to start switching and start like banking on Facebook. But I know it's a contrarian opinion into what maybe some people think.
Yeah, Victoria, let's hear it.
Yeah, so I don't work for Amazon, Facebook, or Google. So everything I say is sort of, just my opinion, obviously.
City's just tiny in comparison.
Yeah. Here's what I think, though, right? And if I was sitting in that seat, is that they are a bunch of really smart people who understand how to iterate and build technology and interface with the consumer and do all these things. And one of the things that people talk about all the time is that, oh, banks are so slow. Like, why can't they just like innovate faster and do things faster, right? And it's actually because we are highly regulated and we take deep thought into every step we make from a compliance perspective, a legal perspective, a bank reg perspective, a risk perspective, reputation, everything, right? And so when you get into this space, you actually take on two things that I don't know if they want to take on. One is extremely high requirements around capital, right? So our capital reserves. And then the second is a huge amount of compliance requirements that would slow you down on one front. And then on the second, it's just a huge cost.